Hello there, glad to be back after 3 weeks. I'm going to do my weekly Pascal's China Lens again, starting now. And of course, I'm going to tackle one of the most hot topics of the day about China, which is about the Chinese stocks and why they lost so much in value. What happened to education technology companies? Is it all Beijing's fault? And can we still trust these stocks in the future, Chinese stocks? And I'm going to give a little bit more detail on the structure and what's really happening and the drive of why the government has taken these decisions and where they are doing it and whether we should trust it or not. Welcome to this week's Pascal's China Lens. The month of July really was crazy. I mean, this was like an earthquake for Chinese stocks. What happened? If you look at the month of July, we saw all of these stocks, Chinese stocks globally, just tumble and lose a lot of value. A lot of people are talking about this Chinese stock bubble that popped, and they will never be worth what they were worth before. And so this is all to do with Beijing and the new regulation and the control that China has over these tech companies. And specifically when we look at education companies, the EdTech companies or online tutoring companies, that was big business in China. But we saw in just 1 day time, they lost 70 to 90% of their value in the US on the stock exchange because suddenly Beijing decided that these companies could not make money anymore. Now, if you've raised capital on the stock exchange and suddenly you're not allowed to make money, I mean, that's not a little problem, it's a huge problem. And so investors got very, very scared, and there's a lot of angst, and people don't know what is going to happen. But to understand what is really happening, we do have to look back and look at the timeline of this whole thing. It started a long time ago. On the 4th of November, we saw the Ant IPO, Ant Financial IPO, that was blocked, it was banned. It couldn't happen. Jack Ma couldn't go public. This was like $300 billion of valuation that he couldn't get. And the reason was that the new banking regulations was not followed by Ant Financial. Later on, it was all about anti-monopoly law. And we saw the same Jack Ma with Alibaba that suddenly got fined $2.8 billion US, 4% of their annual revenue. And then later on, they got fined with other things, and many companies got fined. Everybody's now looking at this anti-monopoly. Even in the education technology companies like Yuan Fudao or Ziyebang, they also got fined just a couple of months ago. And so everybody's looking at this. And then end of June, it was all about crypto. This was about Bitcoin mining that is happening in China for 70% of all the mining that suddenly was illegal. And so people had to move out of China with all their servers. And so this was for energy and for the environment. But the reality is anybody who'd invested in this business now has to move out. Beijing decides something, suddenly everything shakes. And then this month was really a lot. It started with Didi when they went IPO last month. It was end of June. And then after that, the day after, there was this big centennial of China, 100 years of Communist Party. And so they were warned not to go IPO, not to go public, because there was a data security issue with Didi. Didi is the Chinese Uber, and they had to get their house in order and make sure that all their servers were secure, because going IPO could mean that some of that data, which is also location data or geolocation data, could be going into the US. Of course, China doesn't want it. So they blocked all the applications of Didi, 25 applications, and the most important one, the car sharing application, which means this company could not acquire new users. Huge problem. 1 day, a decision, suddenly everything shakes. Of course, same thing on the stock exchange. And then later it was Tencent just a week ago with the music. They couldn't get exclusivity anymore on certain music rights. So maybe Alibaba's going to get into that business now. But it's also the same thing. Beijing decides something, suddenly everything shakes. The value of the shares go down and everybody's worrying. Is this going to happen again? Where is it going to happen? And then the most important was last week with the education technology, where Beijing decided for one industry, a specific industry, which is education, that it would be illegal to actually make money from kids, offering them online education after school, on holidays, and so on. So of course a lot of people in the world were saying like, okay, this has everything to do with the Chinese Communist Party, 100 years, and they want to take control and they want to show who's the boss. Now, I think there's a lot of fear we're having right now. And there's 4 things that you hear a lot in the media that is about fearing China. And so this explains for us in the West, outside China, what is happening and why it's happening. I'm going to tell a different story later. I'm going to use education technology as an example. But the 4 things that we fear most about is that Beijing would control these technology companies. They want to be in power and they don't want Jack Ma's that are too powerful to fail. They also want to make sure that there's more state involvement and not just the capitalism. So less capitalism, more state involvement. They also want to protect themselves. The Communist Party of China or Chinese Communist Party want to make sure that they are not getting controlled by anybody else. So they want to take action before anybody else does. And some people say it's about relocating a lot of capital back to China, because now they're investing a lot of these tech stocks are invested outside China, because there's a lot of money there to invest in these stocks. I think it's none of these things that is the real reason of what is happening. And I'll explain a little bit later, but keep with me. The only reason that we actually have real good grounds to fear what is happening is because there's a history of it. And so it makes sense that people are scared. It makes sense that people are worried. One of the problems is that a lot of the Chinese companies are connected somehow to the Chinese Communist Party, to the state, to the government. And if you look just 20 years ago on the global Fortune 500, there was only 10 Chinese companies and 179 American. Today there's more Chinese companies in the top 500 than there are Americans. And 90% of them are all connected somehow to state-owned enterprises, or they are a state-owned enterprise, and many of them are listing overseas. And the problem is not so much the state-owned enterprise, because they could be very profitable. The problem is that the government sometimes tells them, well, you should invest also in doing something good for society and maybe invest in something that doesn't bring you a lot of profit. And so from an investor point of view, this is not maximizing shareholder return. And so yes, it is a challenge. The bigger challenge, in my view, has been fraud. And there's been a number of companies like Luckin Coffee that has not really been audited correctly, or people were really going crazy about investing in this new business model and suddenly found out that actually there was no ground, or there wasn't enough to be sure that this company would really be sustainable. And I'm not saying it's a fraud, but there's a lot of Chinese companies that, because they're all very young, 5 years, 7 years, some 2 years old, that really raise a lot of capital, hundreds of millions of dollars, sometimes billions of dollars. And these companies, definitely, they don't have the books to show for what they're doing. And then auditing in China is also a different thing. It's not easy. And so there's been a lot of fraud. And so people are getting very worried about the connection with the state, about the fraud, about what is the value of these Chinese companies really. And then there's 2 other problems. One is about the structure. It's called the VIE structure. And this is a gray zone. This is a way for Chinese companies to list overseas. And the other thing is the delisting risk that we're having. It started with Trump saying that any company that is listed on Wall Street that actually has a connection with the Chinese Communist Party, we're going to delist them. And the telecom companies, China Telecom, Unicom, China Mobile, they were all targets. In the meantime, the Commission has decided they won't go ahead and do that, but this is still a risk. Now, to understand this, we have to look a little bit into the VIE to understand why this is such a problem. And a VIE structure is something that is typical for Chinese companies to list overseas. I know it very well because I used to have a VIE myself. I didn't list overseas, but really because I'm a foreigner and I cannot invest in certain industries in China. And so the solution is the VIE. What it means is that a VIE company is a Chinese entity that has to be founded and owned by Chinese residents, people that have a Chinese passport. And the reason they do that is because these company can actually then get a license to operate in China, which is called an ISP license, an Internet Service Provider license. And the problem is that these days, any technology company is becoming a networking company and is doing social media. So you need this license to operate in China, but foreigners cannot have this license. And so the VIE is a solution. Now, the VIE was not invented by China. The VIE structure was actually something that the US invented. And this came back from 2001 with the Enron fraud that happened. And what happened there is basically that Enron was using these VIE structures to hide some of the liabilities that they had. And they put liabilities in specific companies, but the assets in other companies. And that's not legal anymore. And so they created a structure where you can actually have a company controlling another company, even though they don't own all the shares. But you have to consolidate the accounts. And so this is what it is. So if you want to do business like Alibaba or Baidu or all these companies, like 200 companies, Chinese companies listing overseas, they're all VIE structures. Well, you have to have this WFOE, this wholly foreign-owned entity that is owned by foreigners, but it's in China, and they provide services to this VIE, and they get paid for these services. And by getting paid to these services, this money can go out of China because it was a company invested from outside China, typically the Cayman Islands, but it could be anywhere. And that is where the shareholders and the investors are putting their money in that company outside. So they control the WFOE, they control this foreign entity, they don't control the company in China, the VIE. And so this is a gray zone. And the problem is that China is actually looking at this gray zone like, we're accepting this, but we know it's a gray zone, we know it's illegal, and we can stop at any time. And this is what happened with the EdTech companies. They said, you can't set up a VIE anymore. So what if they do this with other industries, other companies? A lot of people are getting scared about that. Now, just a couple of days ago, they reassured that they would not do that and that it's really targeted just to EdTech companies and education because they feel this is not proper for education to make money from education. We'll explain that later. But the real issue is that people are not sure that this couldn't happen again. The bigger risk, in my view, is the fact that the SEC in America, the Securities and Exchange Commission, they actually could delist some of these Chinese companies. And this was something Trump was talking about it, but now they are actually started just a couple of days ago to say that any new IPO that would happen in China would have to be audited and would have to look, they have to look at the books and be quite transparent. And so according to the accounting rules of America, they would have to abide by it. And a lot of them cannot really do that just because of the entities being in China. And so it looks like new IPOs will be more difficult in the future outside China. But on top of that, some of the big tech companies could decide to have a second listing in Hong Kong or delist and go to Hong Kong because it's becoming difficult, because this is actually, they could get delisted. Now, this probably will take a couple of years. I'm told it's 3 years before they really would delist anything. So they could do that anyhow. The question is at what price? So all these things actually makes people feel, and it's understandable that people are scared and don't know about it. But I think we have to look at the details. And I think we have to look at what's really happening in China. And what's really happening is that China's implementing what we call a rule of law. They're just implementing a lot of regulation in every industry because they didn't have it before. And so these big Chinese tech companies or tech companies, they grew very big and became very powerful, but also very valuable, just because there was no regulation or a lack of regulation. So they were in the void of regulation. That was their benefit. I made a movie about that. You can see it. It was on the first movie this year. And I talked about 2021. That's what I predicted. Everything will be about regulation and scrutiny, and there's going to be a lot of things that are going to shake. If you want to look back at that movie, you're going to see that actually this has just all been planned, and it's not new. Actually, if we look back in time, there's 4 big scrutinies, 4 crackdowns, as we can see. And we're always mixing this with the result that we've seen Beijing having one big crackdown, but actually it's very separate. There's one on FinTech, there's one on tech monopolies, there's one on security and data, and then there's one industry related. And these are very, very separate crackdowns. And some of them, like the one on FinTech, started like 5-6 years ago with the P2P loans. That was a problem. Monopoly law has been around for a long, long time, but just this year it's about internet companies, and that's the new thing about it. Data security, China's been serious about it very long time, but from now on, in the next 2-3 years, this is really going to be their focus. And an industry we've seen with environment and energy needs and other problems, healthcare, that they're really looking at every different industry differently to see if there's any risk for the population and the growth of China and the stability of China. But what this is all about is that these are 4 separate entities looking at scrutinizing often the same companies, because these companies are active in 3 or 4 of them. And so when it's about FinTech, this is all about liabilities and making sure you have enough assets on the books to deal with any loans that you have. And so you have to abide according to the banking regulations. Tech companies or FinTech companies are not technology companies. They're actually banks. They should be banks if they do banking business. Anti-monopoly, this is all about market health. I made another video about that. The anti-monopoly laws that I explained in another video a couple of weeks ago, where it's really about protecting the market, the consumer, protecting smaller innovative companies, and so on. And then when it's about data security, this is an interesting one. Because people always say there's no privacy in China, and there's no security, but they're very, very serious in China about that. And it's 3 different parts. It's about cyber, it's about the whole national security, and it's also about data privacy. So 3 different things. And the last one is all about industries. And so the interesting thing is that these 4 things are actually managed by different organizations. When it's about FinTech, this is the People's Bank of China. These are bankers saying you have to become like a bank. When it's about monopolies, this is all about the State Administration of Market Regulation, SAMR. And so these are lawyers, and they want to make sure that you are as a monopoly, or try not to be a monopoly, because if you are, you're actually getting scrutinized. When we look at data, this is all about the Cybersecurity Administration from China that is really looking at data and technology. These are tech guys looking at if your system is secure, if it's not a national risk, and if your data is private enough. And so how are you sharing it? How are you storing it? What are you doing with it? The interesting thing about that one is that China is looking at data as a resource much more than just as something to protect. So it's not just about protecting, it's also about how can we use data, maybe make it open, make it available to smaller companies so they can make money out of it. And that's very, very smart. And the last thing, it's all about different ministries that are actually saying, yeah, you can't do this like Bitcoin, or you can't do this in education. So we have to look at the scrutiny, these 4 crackdowns, as different people attacking different companies at different times with different timelines from the past. And so this is just all coming together now, but there's no plan that this had to become together. It's just coincidence that this year they're all putting it together. Now, if we look at education technology companies, online education companies, we could have seen these warning signs to understand when and how the government is going to act. And even early June, it was very clear that Chinese companies that weren't public yet, like Yuan Fudao, VIPKit, Zuoyebang, these Chinese companies wanted to go IPO, wanted to go public, but they delayed it because they knew a crackdown was coming. The other thing was that a specific department was set up by the ministry exactly to do that. So early June, we could have seen these warning signs. And even before that, in the month of May and April, we saw these companies getting scrutinized for anti-monopoly, so they were already a target 3-4 months ago. But this has also been something that's been going on for 1 to 2 years. Anybody following China knows that the education and innovation are critical for China to grow. And so they want healthy industries. And so this became a little bit an unhealthy industry. Now, what nobody expected was the breadth and how wide this regulation would actually be. And one of the things that is not allowed for private education companies to do these days is actually to teach the school curriculum. It means from 6 to 18 years old, but even for younger, it's not possible, it's not allowed to teach that curriculum. And that's exactly what these EdTech companies are trying to make money from, because this is helping to enter the Gaokao exams. And if you followed some of my videos, you know how difficult that is. Now, the other thing is that teachers were not allowed to teach after school anymore, or they aren't allowed in the future. And that's a ban for teachers, because the big problem was that many teachers were spending more time and energy after school with these online education companies than actually in the class with their students. And so the quality of the lessons went down in the class, and they went up because they could make more money outside of the class. Of course, the Chinese government didn't like that. And so the pressure that the Chinese students are on, and the teachers that are looking for other things, is actually not something that is healthy for the education system. The other thing is that now it's not possible to raise money anymore. They raise a lot of cash, but also not go IPO overseas and not establish or have a VIE entity, as we said. And so Chinese education companies, EdTech companies, online companies, tutoring companies cannot get their students anymore to follow these classes because they're not allowed to. They cannot make profit from it, so they have to find another way to make profit. They can't find the resources with teachers that they need to offer the classes. They can also not raise the capital, not outside China or inside China. So basically these companies are kind of doomed. I mean, how are they going to survive? And that's where I believe they will reinvent themselves. I know it's a long shot, but the reality is that we have to look at what the pressure is that these education companies have been putting onto society, the strain on society. And if you understand that, you will understand, or we will understand, how they're going to reinvent themselves. Now, the pressure on the kids is terrible. I mean, I've made a video about that, about are Chinese becoming lazy? You can look at that video. And this is really about now a lot of Chinese from 3 years old that have to work like crazy. It's like a rat race to get very good points when they're 18 at the Gaokao exam. Otherwise, their future is in jeopardy. The other thing is that the parents are spending so much money on these kids. Usually it's one kid because they can't afford the second kid, because 1/3 or 1/4 of their salary is going to that one child. And so if they have 2 or 3 kids, they have no more money to live on. So the pressure of the families, the pressure of the children who can't play, and so that's what we always say. I mean, they're working like crazy, so that's why they're not becoming creative. But the other problem with China is that there's not enough babies being born, because nobody wants 2 or 3 children because they can't afford it. And so for China, if you link all those three, it actually could solve 3 problems at once. The children could have more time and could actually be more fair between poor children and rich children, because that's the real problem. The poor children cannot afford these online classes, while the rich children, they can. And so this will help with the inequality. It will help with giving a better work-life balance. But it's also something that will maybe help the parents to raise more children. And ultimately, the government is very worried. If you look at 2020, the investment that was done into the industry, is that money, cash, specifically from overseas IPOs that happened, was actually hijacking the whole education sector, which is still a national sector. And so what are these companies going to do? I mean, if you would look at this from a Western perspective, you would say, we're out, there's no more opportunity. But that is not what China wants. Chinese government very clearly said, we just don't want you to focus on K-12 educational courses, because this is fueling this competition and it's actually not good for equality. No, we want you to focus on vocational training, so that people who are not going to university but maybe have a lot of skills and talent, they can actually learn these skills. And China's pretty good at that. They're totally okay that these education companies would go into professional education once over 18 years old and have lifelong learning. I mean, these are all great things. It could fuel also the quality of the education after school, because the education they can't do after school is just for the curriculum. But there's other things like art, maybe creativity, maybe sport. There's other things that they could learn. And ultimately, anything that is a national priority will always remain possible to help these children to become better. Think about coding, for example. And so what we see now is that these education technology companies, which got a really tough time the last week, now have to reinvent themselves. And they have to look at ways to increase the prosperity of the country by offering vocational education. They could help the society have a better work-life balance for people by focusing on professional education. They could enhance the creativity of lots of Chinese, and that's exactly what China needs for the future, by offering more quality education. And ultimately, they could fuel innovation by looking at the sectors that China really wants to fuel. And so, of course, this looks like something incredible that would be nice, but can they make as much money? Probably not. And the reason they can't make as much money is because they were looking at a pain factor of China, which is this Gaokao, and thought parents are going to invest so much money into this. This is where the cash cow of our company is. But it was unhealthy. And so the question is it the Chinese government who's controlling these companies, these EdTech companies? Or is it the Chinese government, if they wouldn't implement these rules, that they would be out of control of an industry that would actually be hijacking the society in a way that it already is, and not help China get out of its problems of creativity, innovation, and education? And so we can look at it from two ways. But I believe most people look at it from a glass that is half full or half empty. And I think it's the wrong way to look at it. I mean, most people look at it half empty and say, we don't trust Chinese government, and so you don't know what's going to happen. Now, people who've lived in China and who understand China, they will look at it maybe half full and say, well, this is just temporary and it will get solved and we can actually get by and there's going to be great opportunity. So it depends on how you look at the glass. I think we should look at 4 glasses instead of 1. And we should look at the societal changes in China, and also the regulation changes in China. And that's 4 times 2. One is about the prosperity that we have to look at. We can also look at other things that China really cares about, like innovation, like creativity. And these are important things. But it's also about this inequality. And so companies and tech companies that are focused on improving the inequality, they're improving the prosperity, they're improving the work-life balance, they're improving things like innovation and creativity, these will always be companies with a future in China. And the other thing is look at the 4 things of the crackdowns and the regulation. So look at the data, look at the monopolies, look at the finance structure, and if this is a FinTech related company or not. And ultimately, we have to look at all the other things in the industries itself that the country cares about and China cares about. And so look at 4 glasses, which are half full, and some of them are empty and some of them are full, and they're empty and full themselves depending on the time frame. And I think this is the way to look at China. And think about it from a rice wine or baijiu in Chinese concept. It's really very potent and very energy fueling drinks that you can get, but you have to be willing to look at it separately and drink it separately. And there's always more wine to fill. And so that is why I believe if we look at the Chinese market and these tech companies from a very detailed perspective, some companies are going to find great opportunities. If we look at it just from half full or half empty, we're probably always going to make the wrong decision. And that's why I think we should trust that the Chinese stocks over time will actually do well, but they have to get through these 4 issues that every company is now having to get through. And this will take time. My guess, 6 months at least, and probably a year or 2 before we get back to a normal situation and growth that we can expect. But on the long term, I'm very bullish still. So I don't believe this is about market control. I think it's really about compliance. And I know a lot of investors are scared about what's happening in China, but we should also realize that the Chinese government is also very scared if they wouldn't put on these rules and regulations. And so who's the most scared? Maybe we should take this into account. And maybe we should understand that once these companies get through those motions and they go through all these regulations, they will become very healthy companies again. And so the question is more the timeline than the risk. And so looking at it for the next 6 months, I mean, it's going to be a wobbly road and we don't know what will pop up again. And so this is a risk moment for the next 6 months, specifically when it's about data security. And so companies that are not doing well on that, it's a little dangerous. And then the rest will take maybe another year or 2 years even before everything calms down and everything is regulated and every company is compliant, which means that that would be the great moment to invest. But then maybe the price will be high. So that's up to you. Hope you liked it. See you next week for another episode on Pascal's China Lens.